I'm so excited today to introduce our guest, Amanda Holden. And Amanda is an award winning money writer, speaker, and educator. After working in investment management for 6 years, she decided that helping rich men get richer was not her calling. Through her business, Invested Development, amazing name, Amanda has taught thousands of women to invest. Using her unique mix of comedy and relatability, she shows her students, often for the first time ever, that building wealth is within their capacity. Amanda writes a women plus money blog called the Dumpster Dog blog. But most of these see, couldn't do it. I was close though. Amanda writes a Women Plus Money blog called the Dumpster Dog blog, but most of the free investing education happens over her Instagram at dumpster.doggy. Amanda, thanks for joining us this morning.
Thank you so much for having me.
So, we typically start off with the standard tell us about your money story question, but I also need to hear about this nickname. So, tell us everything.
The old nickname, Dumpster Doggy, the nickname that every person who's ever given me any unsolicited business advice tells me that I need to ditch. So it is a nickname that I picked up when I was working in investment management. And so I was working for a private money manager in San Francisco, working with all dudes. And it was a great job in that I learned a lot, but I also kind of hated it. And so, I think my fifth or my sixth year, I just got to a point where I was like, I can't do this anymore. This has got to end. And so I got to do every single thing in my power to get myself into a financial position to be able to walk away from this job for good. And I also wanted the flexibility to not have to take on another job because I had started working at this firm right out of college. And so I didn't really think that I wanted to stay in finance. I thought I wanted to do something totally different, but I didn't know what that would be. And so I was like, I got to get drastic times call for drastic measures. You're probably starting to sense where the Dumpster Doggy nickname came from. Basically, I just got super scrappy. And one of the many things I did, and this is kind of just a silly thing, is I was working with all of these men all the time. There was all this food all around us. And so if Brad across the way had a sandwich he was only eating half of, I'd be like, hey, buddy, give me the rest of that. I'm trying to
Let's
say, hi.
go.
Let's do this. And so my coworkers actually started calling me Dumpster Doggy as an endearing, or I like to think endearing nickname. And it's then when I decided to, I left, I traveled, I thought about it. I decided to come back to this world thinking, you know what, I have been teaching my girlfriends this stuff for the last 6 years. Maybe my work in this space isn't done. Maybe I have more gifts to give to this world in this space. And so when I came back, I started my blog and I just named it the Dumpster Dog blog because I was like, well, we'll just like start a scrappy little money blog. And that was my nickname at the time. And so, yeah, so that's kind of the genesis of the actual name. There is a full story on how I became the Dumpster Dog on my blog if you wanted to get into the nitty gritty details.
I'm sure a lot of our listeners will definitely be checking that out.
Yeah, we can link to it. It's actually a pretty funny one in that like it got randomly picked. This story got picked up by Pop Sugar, which was really fun. But then it got picked up by the British tabloids. And the British tabloids completely misconstrued the entire story. They were like, thrifty traveler eats like food out of the trash bin to save $30,000. And it's like, all right, that's selective. That's a selective interpretation.
That sounds like British tabloids. I lived in the UK for a long time, and yeah, that's and I love that you use bin, by the way, too.
Well, they used bin.
Yeah.
they did. And when I first came out, I was like, oh, this is like such a disappointing interpretation of the story. Like I was kind of using the Dumpster Dog piece as just like a literary device just to get your attention.
Right.
But they really took that and ran with it. But after a day or two, I was like, okay, this is actually hilarious.
You got to take it super literally if you work at a tabloid. Can't have any room for metaphors or anything like that.
No, but as someone who read this story and back as a background for our interview today, I highly recommend to our listeners that they tune into it because it's so good.
Oh, thank you.
So Amanda, you were working in investment banking, you're working with all these white men, you're making good money, as I know investment bankers do. So how did you not get caught up in the like glamour and expectations that are, expected of someone working in like a high power career like that?
So what I was doing is a little bit different than investment banking. So I was working for an investment manager. And we still worked hard and I still made good money. But for me, it was a confluence of many things that were just not working for me. One was the rigidity of the firm, the expectations. I mean, I was absolutely working at a place where they always seemed very perplexed at why women wouldn't get ahead. And yet, if you wanted to leave early to go pick up your kid from a dentist appointment, they would chastise you for it. And so it was extremely inflexible. Like the CEO of the firm that I worked at specifically kind of ran his operation being like, we're going to pay you slightly more than maybe the industry average for this position. But the trade-off is that, I mean, and these are his words, like, we're going to treat you like cattle. And so for some people, the trade-off is worth it. But guess who that trade-off works for? It works for men who have wives at home, not for women who are trying to do it on their own, or women who are trying to manage families, or anybody who has any sort of caretaking responsibilities outside of work at all. Anybody who needs flexibility, which also extends to, people with physical or mental health ailments, or people with responsibilities beyond what is generally expected of a rich white man. And so even though I was somebody that was single and fine and could potentially put in the hours, like it grinded my gears and I couldn't do it. And so just from a social justice standpoint, I was like, this is not vibing with me whatsoever. I also had a position where I was speaking with our clients directly. Not everybody has a client-facing position, but I did. And so I was in a position where I was speaking with, old rich men all day. All of my direct coworkers were men. All of my bosses were men. And, I was often the youngest woman or the only woman on the team or on the entire floor. And there were really wonderful things about it. Like, I'd be lying if I said that I didn't like the attention, but to a limit, right? There's a limit to how much you want that attention. And so I had really wonderful mentors, but I also had people that were harassers. And so both coworkers and clients. And so it just wasn't it for me. I was just like, you know what, this is not worth it. I am not intrinsically motivated by a paycheck to begin with. And so, yeah, I was like, it's time for me to get out of here.
Exactly. And what's great is now you are sharing the knowledge that you learned from that career to help women be more financially stable and even wealthy. So tell me, because you said you were helping your friends for the 6 years that you were working there before you decided to do this full time. Why do you think investing seems so confusing, or why do you think there's such a gap to, for women to just dive in and try it?
Okay, well, so first of all, I think that there are parts of it that are confusing. And interestingly enough, one of the parts that is most confusing is picking the right account. I am answering an endless stream of questions about Roth IRA versus 401k versus brokerage account versus what bank should I use, which isn't even investing. That is just picking the account for which you will then buy investments within. But it's complicated. And why is it complicated? It's complicated because the IRS has done this to us. Really, the question of which account to pick and invest within is a question of how you want to be taxed. And what is tax law? It is notoriously difficult to understand and manage. And so if people are feeling like, why is this shit so confusing? You're not wrong. You're not alone. It's way more complicated than it needs to be. We need a massive overhaul of the system to make it much less complicated. But for now, what you probably need is somebody that is the right teacher. And if I'm being honest, it has taken me 10 years of working within the industry, not only having a deep working knowledge of what these things are, but also spending years and years actually figuring out ways to explain these things in ways that make sense. And so I often do that using metaphor, using humor, using pop culture examples, whatever it may be, because some of this stuff is so crusty and dusty. And so that's like the need that I fill right now, is trying to help people deconstruct some of this information, to democratize this information, because it isn't super intuitive. And so, yeah, again, like if you feel like it is confusing, it's because parts of it are. That being said, I also really do believe that there is a finite amount of information that you need to know. There is a set amount of information that you need to know, that once you know it, you're kind of good to go. I think that part of the intimidation factor is believing that you're going to have to be like tethered to your 16 trading screens, shotgunning Red Bulls, trading stocks, and that's what being an investor is.
And like pounding on your chest, like what's his name in The Wolf of Wall Street?
Right. And like, right. That's not a good investing. That's a self-chosen identity is what that is. And so what the encouraging part that I want people to know is like, yeah, there's some stuff we're going to have to navigate. There is a learning curve, but the encouraging thing is that once you know this stuff, there is a start and a finish. Like, sure, engage in ongoing education, but truly know that there is an end in sight, that once you know it, once you understand it, you will take a deep breath and be like, oh, I can totally handle this stuff.
I love that. I mean, really, it's just breaking it down into bite-sized pieces, isn't it? So could you decouple the difference between investing for your future, your retirement, versus investing for a large purchase, like a wedding, a house, a new business idea, something that you want to do for fun, a vacation, whatever it might be?
Yeah.
Could you decouple that for us and our listeners?
Yeah, absolutely. So why do we always start by talking about retirement? I think is a good place to start this conversation. Like, why, when you are 21 years old, is everybody trying to shove retirement down your throat when you're like, lady, I've barely even worked for like 10 minutes. And I understand that. It's like, okay, like I'm just trying to like find a place to live, and you're telling me I need to save for some goal that may or may not happen 50 years from now. That's wild. And I agree that it is wild, but the reality about retirement, and I kind of like to use the term financial freedom as opposed to retirement, just because, for millennials, for Gen Z, I think that we don't even see ourselves as being retired in some way. And I think it's the nature of work. We're always kind of working and not working. And so it's hard to imagine a hard stop to your work. But believe me when I say that after working for 40 years, you are going to at least want the freedom to only choose projects that you want to work on, only choose the work that you want to do. Also, it may not be your choice. I think that the most recent statistic is that more than 2/3 of workers are pushed out of their final jobs before they are ready. And the reason for that is because our jobs and the nature of work changes very rapidly. And if you are a highly paid old employee, guess what? We don't want you on the balance sheet anymore, when we can hire somebody that is much younger and has much better technological skills that we can pay much less. And so you may not even have the choice to work forever. And so we have to be thinking about our future selves as one of our top goals, one of our top priorities. And another reason for this is because retirement is actually going to be New York City. Retirement is going to be the single biggest expense of our lifetimes, which can be both overwhelming to think about, but I kind of like to reframe it like, hopefully it is, right? Hopefully we do get to live for many years, maybe even many decades, only doing whatever the hell it is that we want to do. That's the dream. And so when we think about how we order our financial goals. Like I call it a financial order of operations. It's kind of interesting because we actually start with the closest end goal, which is build yourself an emergency fund, money that you can tap into if you need it in the event that shit hits the fan. There's some other stuff you might want to do, like pay off your credit cards. But then, once we've done that, we actually move out to the farthest reach of our life and we start with retirement, because when we are working on financial freedom, what we actually do is we need to crank that number in. We need to crank that age in via saving and investing, right? Like if you can't afford to retire at age 80, then you can't afford to retire at age 50. And so we actually have to start at the end of our life and pull it in. And so that's why we want to bake retirement saving and investing into every single year that we are able. Now, of course, not everybody's going to be able to do it every year. That's just simply not the way that it works in a very broken American financial system. And so if you have had years where you do not invest for retirement, don't beat yourself up. There's certainly no point in doing that. That being said, it is a goal that is really great to work on whenever you're able. Like I promise me when I say that your cute, adorable, wrinkly, badass future granny self is not going to regret that you prioritized her or them. And so I always consider myself to be like the messenger for retirement. I think it's really, really important to build yourself that financial cushion. And I also believe that we have a moral obligation to our future self, just as we have a moral obligation to take care of ourselves now. And so that's okay. So that's my hype for retirement. And so how does that differentiate, or how is that different from investing for shorter term goals? So first of all, if you're using a retirement account, use it for retirement. We don't need to get into the details of why they are designed the way that they are, but just know that they are retirement accounts like Roth IRAs, 401ks, 403bs, and so on are designed to give you a tax benefit. And that tax benefit is tax-free investment growth over time that really only is powerful or impactful over very long periods of time. And so if you are investing for retirement, do it within a retirement account. If you are investing for another goal, do not do it within a retirement account. I have so many people that ask me, well, can I use a Roth IRA for this? Can I use a 401k for this? I mean, like, sure, you could probably tap into that money if you want, but we are in a retirement savings crisis. Use every tool you have at your disposal to save and invest for retirement, which means leaving retirement money in your retirement accounts to grow over the long term. Now, if you want to invest for other goals, that's totally fine too, but just open up a regular investment account. Generally, what we would call these is a brokerage account. And so, and maybe people want to brokerage, I think, is a word that throws people off a little bit. Think of like the word stockbroker. Like back in the day, if you were to buy an investment, like let's say you were to buy a stock, you would literally have to go to a guy and be like, hey, homie, I wanted to buy 10 shares of XYZ stock. Can you help me out? And he would literally have to turn around and broker that deal. He would have to find somebody to buy it from to sell it to you. Nowadays, this trading, this buying, this selling is all happening automatically behind the scenes on the interwebs at these brokerage banks, but you still do actually need a bank to help you facilitate that trade. And so the major brokerage banks, like my favorites are Charles Schwab, Fidelity, and Vanguard. You can open up just a regular investment account, just a regular brokerage account for which you can then invest within. And so this is just the account piece. The more important piece is then how do you actually invest that money? And so with retirement, with longer term goals, it's actually a little bit easier because you have the time to allow the stock market to work in your favor. So you can do a strategy that is very heavily invested in the stock market. Now, you may want to diversify a little bit out of the stock market, whether that's with bonds or some real estate holdings. But for the most part, we're talking about investing in the stock market for the long term. Now, the interesting thing about stock market investments is that they become, and specifically like broad stock market investments. So if you were to buy like an index fund that invests you in the entire US stock market, the thing about that investment, which is a great investment if you want exposure to the stock market, is that it actually becomes less risky the longer you hold it. It is less risky the longer you hold it. And so as long as you're willing to give the stock market your retirement dollars decades to work, you can be all but 100% certain. I mean, like, I shouldn't say 100%. Nobody knows what's going to happen. You could be almost 100% certain that the stock market will have moved higher, even despite any short-term wackiness that we may experience, which is absolutely a hallmark of stock market investing. You know, if we know anything about stock market investing, it's that these two things, these two patterns, continually reveal themselves to be true. And that's that in the short term, it's up and down and up and down. And we cannot predict when those ups and downs will be. But over the long term, the stock market does move higher. And so this actually poses a bit of a conundrum for short-term investing, because the stock market is volatile, period. It's just going to be volatile. There's no way around it. We do not control the stock market. We are really just along for the stock market ride. And so when you are investing for the short term, you're on the stock market's timeline now. You're no longer on your timeline. And so if you have a wedding date in the future that is set in stone, I would not invest that money in the stock market, because you want to be on your timeline, not the stock market's timeline. And really, for shorter term investments, especially when we're talking about investing in the stock market, really in any way, whether you're using funds or you're investing in individual stocks, it's much riskier. You are, again, now on the stock market's timeline, not your own timeline. And you have to understand that we could experience a stock market crash at any point, right? Like, you could be investing like in 2008. I mean, in 2008, the US stock market across the board was down 55%. So if you're saving up for a down payment for your house, you have to be willing to take that risk, knowing that next year the stock market could be down 55%. And only you can determine whether any potential upside in the stock market is worth that downside risk.
So I have a reflection on what you've just outlined for everybody here. And first off, thank you, because I feel like you really broke that down, two very complicated topics into, and you broke it down in a really easy to understand way. A common theme I saw across the two of these is understanding what's in your sphere of influence and what's outside of your control. And can I just say thank you on behalf of our listeners, on behalf of myself, for emphasizing this point about not having control over your job. I think that's going to be a big disruptor, especially for millennials, as we're facing our later career stages. And I'm quite frankly already seeing it now at work. Anecdotally, some of the new interns that are coming in are so sharp, so bright. Like, they've got the tools, the skills, they're confident, they're articulate, and I'm not threatened by them. But at the same time, I look at what they can do, and I don't know that I'll ever be able at this point in my career, also just given what my priorities and expectations of my level and rank and role are, I don't know that I'll ever be able to go back and catch up with them on these data science degrees that they're coming out of undergrad with, knowing how to use some of these tools. That's just not how my brain works, but that is where the world is headed, right? And so many people talk about retirement as a choice. Like, oh, you decide when you're going to stop working. You're going to decide at what age you're going to, decide to start pulling out of Social Security, if you're ever going to rely on that, or your 401k. But actually, what I love is that you've pointed out that we may not have a choice, even if we do want to work until 75 because we have to, because we had so much debt or such a large mortgage or whatever life costs we absorbed over time. We may not have that. So start thinking now thoughtfully and artfully about it, and purposefully, because the longer we go, the fewer choices might be available to us, right? Like, I feel like I jumped around a lot earlier on in my career. Is that going to be such an option for me in 5 more years? Maybe not. So I just think that was really important, because a lot of people we bring on the show, we talk about retirement, we talk about compound interest, we talk about how you need to get in on it early. We don't talk about the macro factors that we have zero control over, like this next AI revolution that could displace a lot of our jobs today as we know them. So thank you.
Yeah. Yeah. You're welcome. I mean, I spent a lot of time thinking about how to get people to care.
But you do it
About
in not a
retirement.
doom. Yeah, but it's not in a doom and gloom kind of way. It's just
Yeah.
like, hey, guess what? Like that train's coming. So don't lie down on the track. Like you're letting people know, but not in a scary way.
But I think what I got out of what you were just saying, Amanda, which, I mean, when you're talking about retirement, especially, like I was in high school when 2008 happened. So I was literally sitting in Mr. Fay's US history class when like the Great Recession was starting and the stock market was going down. And I just remember we had to do like like we had to watch the news and we had to pretty much understand that like stocks are going down and people were hearing things about retirements and all these different things. And I remember sitting there and Mr. Fay is teaching me what like Social Security is and all these like things that usually are there and support systems that our, economy will have to support us in retirement. And he just said straight up, he was like, these are not going to be available for your generation. Like that's just not even something that is going to really be there. It's not going to be supportive for you. Your retirement is whatever you like can do for yourself. That's pretty much it. And I remember absorbing that and having no freaking clue what then the next step is. Like, okay, so it's up to me, but what does that actually mean? And I think what you just said is you need to know that lesson in high school and in college because time is really your advantage. It's the only thing that you can control is when you start. And then after that, like the stock market will do whatever it does, that is, it's just inconvenient if you decide to retire the moment that the stock market completely dips. But the idea is we have, 30 or 40 years to work towards creating a cushion for our life. And I mean, it cracks me up sometimes because, I'm in my 20s. I have lots of girlfriends and younger siblings who, I say all the time, like, hey, did you start that investment account? Hey, did you start that retirement account? And they're like, oh, yeah. Like, yeah, I'm going to start that next month or like next month. And then, 6 months go by and I'm like, hey, did you set that up? Because, I don't know if you saw, but like the stock market's doing well, or like, are you setting yourself up? And they're like, oh my God, yeah, I meant to do that. I'll do that next week. Next week sounds like a good time. And every time, I mean, at this point, like years have gone on where they haven't done it. And I just am thinking like the long-term implications of that is crazy. And I don't know how else to explain it. So Amanda, how do you kind of create urgency where it's like, okay, 2 years might not seem like a long time, 6 months might not seem like a long time, but when you break that out over 30 years towards your retirement, that does make a difference, doesn't it?
Yeah, it does. And you're absolutely right in that your youth is really your superpower when it comes to investing. And you can do so much less work if you get started young. And so I kind of like to emphasize that because I, as a naturally lazy person, would prefer to do less work than more work, but it does mean getting started on the earlier side. And so in an instance like this, I don't generally like to break out the compound return graphs because to me, we've heard it a million times. It doesn't feel particularly motivating. Like Catherine said, I kind of like talking about retirement in terms of, what is the landscape of work going to look like moving forward. But I think with somebody younger, just showing them how much less work they can do by actually helping them map out the numbers, actually having them use a compound returns calculator to show how the money that you invest when you're in your 20s is so much more powerful than the money that you invest anytime thereafter. And so it might be worth it to do that. I mean, that's the problem, right? Like, and I want to pretend like I have this solution, but I also kind of feel like people only come to you when they're ready. I've even taught a lot of personal finance classes in high schools, a lot, more than 100. And I'm all for mandatory financial literacy in high schools, but like, let me also promise you that until you are really faced with maybe like a job you don't like or a financial situation that really requires your attention, then you just don't give a shit. And so, sometimes it just takes like that
Life experience.
one life experience that really like jabs you in the heart. And for me, it really was hating my job to the extent that I needed to do something extremely drastic. And so I don't know if it's, maybe kind of more even just tapping into the emotionality of what it is to trade so much of your life for a paycheck to buy essentials. Like that sucks. Like, is there a way that we could game this system, use the tools at our disposal so that we are not tethered to a job for the rest of our lives? And so I think that that's an important conversation to be having as well.
Definitely. And I did want to bring up one more thing that you touched on earlier, which is, using your retirement accounts for retirement. We do, hear stories all the time about people dipping into their 401k to buy a car or to, fund their lifestyle that they're living over their means, or even just for a down payment on a house. So how can you like set yourself up to still, have that down payment or buy that nice car, whatever it is that you're like trying to do a large purchase for, but without touching your retirement accounts?
Yeah. And so like a little forethought goes a long ways here. I should say that, if somebody is tapping into their 401k because maybe they have an emergency or something along those lines, like that's okay. Life happens. It is your money. And so no worries if that is the case. But if it is something like buying a car, which that like makes me recoil inside a little bit.
Sorry, just put the bile back down.
Oh my God. A depreciating asset, no less, then, plan for it, right? Like, I also think it's not totally fair for financial educators to talk retirement, and not address the fact that people are going to have other things that they want to save for, and that is also okay. I think from our position, it's just like we see that we are in a retirement savings crisis. We know the numbers. We know that elder women live in poverty 3 times more than elder men, and that it's worse for women of color. And so we are marinating in this information, and we have worked firsthand with people who even have a lot of money saved, and they're still stressed about having enough for retirement. And so we know, and I think that sometimes we can become a little bit singular in being like, do the retirement thing, get your Roth IRA open, get started, without also addressing the fact that like humans are going to have wants and needs along the way as well. And we need to be planning for that so that we don't then dip into our 401k accounts, which could cause us to incur a penalty. We might have to pay taxes. And even more than that, like, whatever, you pay taxes, but this is money that really is supposed to be earmarked for the long term, because again, retirement is going to be the biggest financial goal of our lifetime. And so that's really the primary reason you just want to leave it in the 401k. That's really it. Like, yeah, penalties, yeah, taxes, but really the reason that we want it to be there is because we got 30 years of living without an income that we need to be thinking about at the end of our lives. And so yeah, what can you do? Just plan for it, right? Like if you want to save up for a down payment, that's great, but don't do it within a 401k. Don't do it within a Roth IRA. A really simple thing that you can do is simply open up a high yield savings account, or really just any savings account that you have already that is separate from your checking account, and just start stashing away some nuts. You know what I mean? Like that's, there's not really a lot of magic to it. I think that, even Catherine, to come back to your question about how do we invest for the short term? A lot of people want there to be some silver bullet for short-term investing that certainly does not exist. The way that you save up for a shorter term goal is to do the work of saving. There's not really magic beyond that.
And it comes at a cost in another area of your life, right? Like if you're saving for your wedding, you're probably not going on some fantastic trips with your friends or buying designer handbags or splashing out in some other really fancy dinner for months and months on end in the lead up to it, right?
Exactly. And so like, it's kind of up to you to then determine what those buckets are. Like, I kind of like view it as like, okay, so emergency fund is like the first bucket. And then once we have spillover, retirement is the next bucket. And then after retirement, and obviously you're making all your debt payments along the way, but then after, retirement is set up and you've got your financial infrastructure built out, then we can start to have some fun. Then we can start to fill up all the other buckets that you want to prioritize, whether that's a wedding or it's a jet ski or whatever it is, that's going to be up to you. But yeah, like you said, you're probably not going to be able to save for every single goal.
Do jet skis depreciate as fast as cars?
I don't really know.
I don't know,
bet
but
they
we
do
should look into
faster.
that. Oh, really?
I bet they do.
Anything in the water probably depreciates faster.
Yeah, I feel like the gas on those is nuts. I mean, definitely boats.
Yeah.
Try to sell a boat, honestly. I mean, like, hi, I've got this boat that I gotta unload. I don't know.
Yeah, I mean, nobody
hard.
would want it because everybody would want jet skis. So
Yeah.
It's just like, there's not even a market for it.
So, Amanda, you talk about having done financial classes with teenagers. And so the next question is kind of geared towards, I think, maybe someone who would be starting out with this chunk of money. But what would you say for those starting out? What do you do with your first $100 to invest?
So I think that starting out with a Roth IRA account is a great option. If you don't want to go the retirement account option, then just open up a regular investing or brokerage account. That's fine too. And then I would probably do it at either Charles Schwab or Fidelity, which are two low-cost brokerage banks. And by low cost, I mean you don't have to pay for accounts. You also have a whole universe of really great low-cost investing options, which means that you can use that $100 and get it all invested into the market without having to sliver any of it off to Fidelity or Charles Schwab. And so you first open the account. So let's say you're doing a Roth IRA. Step one, open the account. Step two, move that $100 into the account. And then step three, you got to actually get in there and purchase an investment. And so a really great starter investment would be an index fund, which a fund is really nothing more than like a big old basket of some other investment type. So whether it's a mutual fund, an ETF, an index fund, really an investment fund is nothing more than a big old basket of stocks or a big old basket of bonds or a big old basket of real estate holdings. That's all an investment fund is. And funds are kind of genius in that for small investors like us, we can buy one investment that is actually going to invest us in hundreds, maybe even thousands of investments. So it's a beautiful little diversified investment all in one little beautiful basket. And so an index fund is a great option. Those are low cost investments that just invest you in a really broad way across a market. So for example, an index fund that invests in the total US stock market is a great option. Another really great option is an index fund that invests you in the S&P 500. So the S&P 500 is just a measure of the US stock market. It's the 500 leading companies in the United States. And nowadays you can buy an investment that mimics this measuring stick that is the S&P 500. And so whether you do a total US stock market fund or an S&P 500 index fund, basically you are owning the entire US stock market with just one purchase with $100. With $100, it's going to be easiest to use an index mutual fund. And so look for an index mutual fund at Charles Schwab or Fidelity.
So first of all, thank you for getting to step 3 because I totally failed at step 3 when I first started because I was like, look at me, I got my Fidelity account, money's in there, we're good to go. And then I was like, oh, like,
why isn't it growing?
Weird.
Why has it not gone up?
Which, by the way, you're still paying for, so just annoying. And like all the reinvestment dividends, didn't realize that there's a button that just automatically does that too. I was like, what? So brilliant. But I wanted to ask if you could go into a little bit more about costs, because I think that's another thing that so many of our listeners are like ask us about all the time. Like, what is an expense ratio? Like, when you're saying like low cost. What does that mean? I think a lot of times people are like, oh, I don't need a financial advisor because that's costly, or like, I don't really know how to decide which broker because I don't understand the cost structure. Can you go into that a little bit?
Yeah. And so first I will say that with these banks, there's any number of ways that they can charge you fees. And so, and to the extent that like we would need another podcast for me to break down every single way that you might encounter a fee in the world of investment management.
Did you just offer to return and do a whole episode on fees with us?
Sure.
Because I will tell you that's the thing that actually trips me up. That's the thing that has stopped me in the past, where it's like, oh, I keep reading, you shouldn't pay someone to do it. And then I do nothing. And actually, I'd probably be better off if I did pay someone to do something in the short term while you get your feet wet. Maybe. I don't know. So sorry.
Yeah. No, that's really great. And let's circle back to that point. Remind me if I don't remember to get to it. But let's circle back to that point. So knowing that, okay, there's all sorts of ways that you can be charged fees. Let's just say up front, for anybody that's their eyes are gonna glaze over when I start to get into this, that a really good way to ensure that you're going to avoid fees is to just use index funds. To use index funds at one of these low cost banks that I've been mentioning. And low cost is not like a term that I came up with. There's really two types of brokerage banks. There's low cost brokerage banks and there's full service brokerage banks. So Fidelity, Charles Schwab is Vanguard. They are low cost brokerage banks. Goldman Sachs is a full service brokerage bank, which you would pay a lot of money to have somebody manage your money, but we don't even need to worry about it because we don't have enough money to even be clients of Goldman Sachs. So let's not worry about that. And so a good way to just make sure that you're keeping as much of your money in your own pocket as possible is to just buy an index fund at one of these banks that doesn't charge you also to open an account. And so that's the safest, easiest way you can avoid fees. Now, something I just said there that's really important, keeping that money in your pocket as opposed to the pocket of the banks. Because here's the thing that I think is maybe a little bit misunderstood about what you're paying for. So the stock market is only going to give us what it is going to give us. People that are actively managing stock market portfolios historically have done a very, very bad job of providing value above and beyond just the average returns of the stock market, which, by the way, you achieve with an index fund that you pay nobody for.
Because you own the entire stock market.
And so you achieve the average. And so knowing that, the way that we actually need to approach investment fees is with just kind of simple arithmetic. So for example, if we think that moving forward, the stock market is going to return 7% per year, we say annualized. Hold on, somebody's at my door. Sorry, let me start over. Again, New York City.
Love it.
Okay, so it's really simple arithmetic. And the first thing that we do is we start by thinking about what we expect to earn in a certain asset class. So for example, the stock market. So let's say that moving forward, our general expectation is that you're going to return 7% per year. That's the average. And so then let's say that you are paying 1% in a fee to a manager. And so let's give this active money manager the benefit of the doubt and say that they just return about the average, 7%, but you paid them 1%. So you take 7% minus 1%, you are left with 6%. Or let's say that, you expect that the market is going to return 6% per year moving forward. We don't know. We can't know what it's going to return, but 6% might be a nice conservative estimate. So again, a 1% fee is 6% minus 1%, you're left with 5%. When we hear a 1% management fee or expense ratio is just another word for management fee, we tend to think, oh, 1%, that's nothing. Like, can you imagine like going to a happy hour and then being like, oh, it's 1% off all beers? You'd be like, fuck you very much. That's
a
insulting.
Quarter. Thanks so much. Yeah.
What if they were like 1% in perpetuity?
Right. I mean, like, I don't know. Like, I think you'd be
Or
like,
if they
I'll
were
just
like,
go
you
ahead.
get 1% more beer, you're like, wouldn't have noticed that.
No.
Thanks so much.
Like, I'll just pay full price. Why are we even having this conversation?
Right.
And so we think when we hear 1%, we think in terms of shopping or, what you would expect in, like, let's call it the real world. You think of it as if it's one piece of a 100 piece pie. But in the world of investing, with this simple arithmetic we're doing, it's one piece of a 6-piece pie, right? You are immediately giving up almost 20% of your returns by giving up one piece of your 6-piece pie. And so in the world of investing, a 1% management fee is a lot. Even a 0.5% is a lot. And so you need to know exactly why you are paying that fee, what you are getting out of it to make it worth it. Now, Catherine, to come back to your original point, what's something that could be worth it? Well, what I would say is something that you really can't expect is somebody to do better than the market average, to do better than the stock market average. So if somebody is trying to sell you on an actively managed strategy that is going to outperform the market, just know that these guys that are sitting in huge sky-rise buildings in Manhattan with snakeskin loafers that are making millions of dollars are not actually generally adding additional value to their portfolio. The entire point of management fees is really not to do better than the market. It's to procure fees from the consumer and move it to the bank. That's literally what they do. And I would say, actually, some of these fees that are embedded within the funds themselves is the single biggest scam in the history of the financial services industry. And so if you are hoping that somebody is going to actively manage your portfolio to the moon, I would be a little bit leery of that, because history and data has shown us that they cannot do that. 99% of the time, they actually underperform. So more arithmetic, if they underperform by 2%, that's 2% that you can chop right off your potential average. Active money management is really difficult to do. It requires a lot of luck. And so that's not what I would pay for. Now, what you may want to pay for. So for example, a really big example of this is using a robo-advisor. So using like a Betterment or an Ellevest or a Wealthfront, which, by the way, they all offer the same exact service. And that service is buying index funds for you. And they are going to charge you a little fee on top of it. It's 0.5%, which I shouldn't say little. I mean, 0.5% is reasonable, but it is not nothing. And so really the choice then comes down to, should I DIY it myself, buy my own index funds, which is the cheapest option, or should I use one of these automated robo-advisor services and pay them to buy the index funds for me? And there's not really a right or a wrong answer to this. I buy my own index funds because I am very confident in my ability to do that. But using a service like this, which, to be honest, they are easy and beautiful and streamlined, and their UX design blows Fidelity's out of the water. And so, if you are somebody that's like, I just need a kick in the ass to get started, please use one of these services. It is absolutely better to use one of these services than to do nothing at all.
That's the new easy breezy beautiful.
That's the
new easy breezy beautiful index funds.
The new cover girl invests her money. Yeah.
Ooh.
So, okay, I think it's my turn, isn't it, Katie? Sorry, I totally dropped the ball. We've got our notes up and we kind of like carve out who's going to ask which question. But we wanted to ask you before we close, just being mindful of time. You have a course called Invested Development. Can you tell us a little bit about what the course offers and how we can access it?
Sure. So it is all online. So it's 15 video lessons. Take it at your own pace. Super fun. Like I mentioned at the beginning of the call, it is designed to be start to finish. So you walk away from this course feeling completely confident in your ability to do this yourself. Or maybe, after learning, you decide you want to use some sort of automated option, but really I'm going to give you all of the educational tools necessary so that you can make smart investing decisions. And so it's It's really fun. I teach using humor. One of my students called it Netflix that makes you rich, which was like the nicest compliment
Love
ever.
it.
That is the nicest compliment
know.
ever.
I know.
And is it a pre-recorded course or a live course? How you said it's 15 parts, right?
Yes. So it's all on video. So it's take at your own pace.
Mhm.
That being said, there are live elements as well. So with the course comes office hours. So once a month, I post up in a Zoom room. You can come and ask me all your questions, whether they're clarification questions or you actually just like want me to help walk you through your 401k options or whatever it may be. And so I stay there until all questions are answered on the first of every month. So you do have access to me as well. Also, and I actually just announced this yesterday, 2 days ago, I don't know when this podcast will come out, but I am also going to start integrating back into the course, me teaching a few lessons live each month. This is probably too much information, so you can certainly cut it out, but I used to only teach it live. I used to teach it live, like boot camp style over the course of a month. A year ago, I did convert it all to video, which was just a necessary change for me to be able to scale my business. Also, people wanted a video option. And so like, right, women, moms, we're all busy. And so they wanted a video option. But what I've noticed with my course is that people buy it and they don't do it. And I could just not give a shit. That would totally be an option, but I do care. And so
But you give a shit.
I give
Thank
a
you,
shit.
Amanda.
I know. And I want my students to succeed, especially if they invested some money into doing this. And so I'm actually starting in June going to be teaching live lessons each month as kind of just like a spiritual jumpstart, as like a kick in the ass to get you motivated to get through some of the material. So it's video, it's live, you have access to me, it's all the things.
I'm definitely one of those people who, if I paid for it and then somebody is expecting me to be somewhere or do something, I will do it. But I also like have done the thing where I bought something that I'm like, oh, look, I bought those leggings to work out in, and then never put them on because why would you work out? I don't know. So thank you so much for your time today, Amanda. We really enjoyed it. We do finish our episodes with just a fun question so that our listeners can get to know you a little bit more personally. So our fun question is typically, what is something that you will always splurge on? And what is something that you will always skimp on? My traditional example is that I do not spend any money on delivery fees. That is something I just physically hurts me to do that. It's weird. It's like a $3 charge that
You're
I can't
not a normal
do.
millennial.
Like, it's so
Katie.
weird.
Yeah.
But like, even I was going to buy a couch on Pottery Barn, and there was $100 shipping fee, and I was like, I can't do it. I literally can't buy this couch now because $100. It's ridiculous. And then, but I will like walk like 3 miles to buy like some really bougie, delicious sushi. So I like splurge on like really high quality food, but I won't pay like $3 for them to deliver it. So it's weird.
Yeah, no, I mean, actually, I'm kind of the same. So I mean, not always. Like starting my business, I was not doing anything, but I love to anything involving my social life. I'm going to spend money on if it involves people, especially after this dark winter and pandemic. Like I'm ready to like take this vaccine for a joyride and have a little bit of fun. Okay, so I will be out there in New York City buying $19 martinis. I know it's only this much liquid. It's like a $19 cup of poison, but I'm going to buy it. I don't care. And so that's something that I will always splurge on. I also, I have only ever used a food delivery service one time in my life.
Wow, that's amazing. That is amazing.
Yeah. I mean, like, of course I've like ordered pizzas and stuff in the past, but I've only once used like an Uber Eats or one of those.
But you don't have like 7,000 Grubhub points or like any of those things.
Yeah, I don't think I've ever used Grubhub.
Yeah. Yep. Same. Well, it's actually funny. You should try next time that you're out in New York City, ask them for 1% more of the martini, because that is like liquid gold. It's very expensive per drop. My fiance actually cracks me up because he hates martini glasses because they're built to spill. And he's like, every drop of that is pretty expensive.
It's so true.
He's so frugal. I love it.
I know, he's pretty frugal. It's weird. I don't know if that has any impact on why we're together, but weird. But thank you so much, Amanda. I know I learned a lot. I know our listeners are going to find this extremely valuable, and we definitely will take you up to have you back on to talk about fees.
I would love to. Thank you so much for having me.
Thank you again, Amanda.
You're welcome.
Awesome. Have a great weekend, everybody. And we will send you this episode when it's all edited and good to go.
Yay.
Thank you so much. All right. Bye, ladies.